So good morning. You'll see my frozen screen there. I'm Jennifer from the League of Cities and Towns, and we are happy today to have our friends from RIPEC back again, to much acclaim. Michael DBAs and Justine Oliva are going to talk to us a little bit today about the business climate here in Rhode Island, based on some recent studies that have been done. So I'm going to turn it right over to you, Mike, and make sure I can get everybody else back into this meeting. So thanks for being here.
Thank you, Jennifer, and thank you for everyone who's on. I see some familiar faces, including our RIPEC recent RIPEC award winner, Trish Sunderland. So
Good morning.
great to see everyone here. I know that many of you know what RIPEC is, but we're not yet a household name. So I do want to remind people that we're a 501c3 nonpartisan public policy research organization. We focus on taxes and spending at the state and local level in Rhode Island. We also spend a lot of time on K through 12 education, and we've recently added housing to our portfolio, though we haven't done any reports or public work on that. We're still trying to get smart on that area. And each year we've been doing a policy brief that analyzes Rhode Island's ranking on the Tax Foundation's annual Business Tax Climate Index. And we do this policy brief each year, basically analyzing that ranking. Justine Oliva, who's on with me today, who's RIPEC's research manager, is a principal author of this, and she will answer any hard questions, or probably all the questions. I wanted just to remind people that these are not RIPEC's rankings. We are analyzing the Tax Foundation's rankings. We do work closely with the Tax Foundation. We have a high regard for their work, and we do talk to them about the rankings and to better understand them. But I just want to let people know this is a completely derivative work in terms of the rankings itself. So if we could go to the next slide, kind of summarizes the Tax Foundation. So they've been doing this Business Tax Climate Index for 20 years. And it's based on a principle that tax systems are important, and that even though taxes are one factor, that they are significant to competitiveness among states. So I just want to say at the outset that the relationship between taxes and economic growth and business development is a complex one. We know that businesses make decisions about where to locate and whether to expand or relocate to a large degree on operating costs. We know that operating costs are important, and taxes are a part of operating costs, but they're typically not the largest part. There's other factors like infrastructure, availability of skilled labor, that go into a business's decision. That being said, competition for businesses is largely regional. That's what the Tax Foundation tells us. So we're competing for businesses in the Northeast region or with other states in the United States. We're typically not competing internationally. And the region that we sit in has consistency with respect to some of those other factors like energy costs and infrastructure and skilled labor. So taxes do become more important. Some people argue that this whole exercise doesn't really make sense because taxes are on the margin, and we would submit that on the margin actually matters because companies have small margins and they're trying to improve their profitability. So we can talk more about that with Q&A, but I just wanted to get that kind of right up front. So the way the Tax Foundation does this ranking, it's a fairly sophisticated, they use 125 variables, and it's basically a composite of rankings and scores from 5 different categories. You see them here, which have different weights based on the fact that there's variability. So where there's less variability among states, then they don't factor as much here. So, and they actually make methodological changes, and they actually make modifications, both backward and change rankings in the past. So this index for 2023 covers FY23, which is, so it's very current. It's for the fiscal year that we're sitting in right now, so it's picking up those tax changes. And I'll go now to, this is Rhode Island's overall rank, and you'll see that we got as high as 38th recently, but now we're at 42, which is the first time we've been in the bottom 10 since 2015. We fell, not that we did things that were negative, but rather that a couple other states that were close to us did some positive things. Specifically, Louisiana and Arkansas made some changes to their corporate and personal income tax structures. So that's why we fell, which is important. It's more because we stood still than we actually were doing things that were negative. And then the next slide shows where we fall in New England. So New England as a whole, with the exception of New Hampshire, is a relatively high tax state for business. As you can see here, we're more competitive than Connecticut, which is at 47th, but less competitive with Massachusetts, and New Hampshire obviously is in the top 10. So New Hampshire kind of stands alone. We do think in Massachusetts that their ranking will become less favorable fall because of their millionaires tax, which passed by referendum in November, which would impose a 9% tax on income over $1 million. The current top bracket or the only bracket in Massachusetts is 5%. So by way of comparison, Rhode Island's top personal income tax rate is 6%. And so we're gonna go through each of these factors, each of the composite factors, and just talk about them a little bit. And I know this is very nerdy, but I know we have some finance people that find tax rates and things like that interesting. But so the individual income tax is the most important factor for the ranking. As many of you know, the great majority of businesses in Rhode Island are S corps, they're pass-throughs. So they pay taxes on the personal income tax side, not on the corporate income tax. Income tax also affects the cost of labor. So the higher personal income taxes on your workers, the more you have to pay in salary. And you'll see here that Rhode Island is in the bottom half. We're at 33. We have a relatively progressive tax system. We have 3 tiers. Other states have a flat tax like Massachusetts. See, Massachusetts, which used to be called Taxachusetts, is ranked number 11th on the personal income tax. New Hampshire only taxes interest and dividends, so they're in the top 10. But you'll see that we, compare favorably to Connecticut and Vermont, but we're below Maine. So we fell two spots here because of improvements in other states. The sales tax is the second largest category, and it affects businesses in a couple of ways. One is the taxation of business inputs, things like energy and services and certain supplies that businesses need to buy. Manufacturing inputs are typically not taxed. So when business inputs are taxed, it does result in a double taxation for businesses, because then the profits are also taxed on the other end. And we have some of that in Rhode Island, but not as bad as some other states. It also affects consumer demand, because if there's a sales tax on goods, then it affects the ability of consumers to buy because the goods are higher taxed. And this is even more important in an online sales environment. So you'll see here that, and the governor has proposed a cut in the sales tax. We have one of the highest state sales tax rates, but we don't have any local tax, and a lot of states do. So our combined rate is actually not that high. You'll see here, we're 24th when you combine state and local. And we also don't tax food and clothing, so we have a relatively narrow base. So our sales tax actually comparatively is not that high. We're ranked 24th, which is sort of counterintuitive to people because they see that 7% and they think that we must be a very heavy sales tax burden. But the tax foundation index has us pretty much in the middle of states. You'll see the next category, the corporate income tax. So these are taxes that are paid by C corporations, which are your largest, mostly public companies. And you'll see that we rank 40th here. We did reduce we did improve recently because we reduced our top rate from 9 to 7%. But we have some other things that are not great here. We don't have very generous tax loss provisions. There's something called the throwback rule. It has to do with taxing corporations for their income in other states that they don't report in those states. The tax foundation also philosophically penalizes states for things like economic development tax credits, investment tax credits. They don't believe that those are good things. A lot of people view those as pro-business, but from the tax foundation's point of view, they see those as complications and things that cause other corporations to pay higher taxes if they don't have them. So we get penalized on that. So that's why we're at 40th, even though that 7% rate is not bad compared to other states. We also didn't, while we stay on this, we also didn't incorporate some of the favorable tax changes that the federal government made a few years ago, when there were some big tax changes by the Trump administration. Property taxes is the thing that the folks on this call have most power over and most interest in. New England performs poorly here. You'll see all of the states are ranked in the bottom 10, and that's historically there's a heavy property tax reliance in Rhode Island. Rhode Island has the 9th highest property tax collections per capita, the 7th highest as a percentage of personal income. So we're actually best ranked of the New England states here, but the ranking is 41, which is about what the overall, pretty close to the overall ranking. And you'll see some of this has to do with capital stock tax, which we got rid of phased out in 2015. We'll talk more about this in a moment, but this is a New England issue. And the other thing I'll say is that businesses are hit with this tax regardless of whether they turn a profit or not. So it's a fair tax, but it's also you can also be a heavy tax on business. And then unemployment insurance, we're ranked 49th, only 50th, only Massachusetts is worth at 50th. We've historically had a fairly generous unemployment insurance tax system, and we also have a surtax that goes to job development on top of that. So we have a fairly generous dependent provisions, and we're among only a few states that fully charge the last employer, regardless of whether an employee had maybe worked someplace else for a longer period of time. So this is the unemployment insurance tax has the lowest weight. And so I'll close out with a couple of our comments. So we improved. We went from 44th in 2014 to 38th, but since then we've been backsliding. So in the last year we fell from 40th to 42nd, and we're in the bottom 10, as I said before, for the first time in several years. The cause of that is mostly because other states have improved their tax climate, and we haven't. We are better than Connecticut, but still behind Massachusetts, which are our two principal regional rivals. And, one thing about that is we're a very small state. So in terms of business location, businesses can very easily move across the border, unlike almost any state. There are some cities that have borders that were close, but, businesses really don't have to be located here to reach our market. So we do have this, we do have somewhat more intense competition with Massachusetts, probably more than with Connecticut, more with Massachusetts, just because of the way the economy is in nearby Mass. And the point is that there are some potential reforms that would have a limited effect on revenues. Other reforms would cause an impact, but we would argue Rhode Island's in a relatively favorable financial position right now to make its tax structure more competitive. And we've actually seen other states, many other states have taken this opportunity with sort of this abundant resources from the federal government, and also big upticks in state revenues to lower broad-based taxes and business taxes. So our recommendations are, first and foremost, we think the property tax is the most burdensome tax on business, and we think that we should be addressing that in Rhode Island. Now, the most direct way to do that would be to put limits on cities and towns in terms of the split roll. Split roll is the difference between the tax rates between residential and commercial and tangible and homeowner and non-homeowner. Other states, the most direct way would be to say, you can't charge more than 50% or 100%. We don't think that's that practical in Rhode Island. We don't see the General Assembly actually putting those kind of guardrails in place. So our next best idea is we'd like to see, and we have a proposal for a partial phase out of the tangible tax, which we think is a terrible tax for business. There's some very high rates. Businesses often pay sales tax on these properties. The depreciation schedules are very ungenerous as compared to how they're depreciating it for tax and accounting purposes. So we're going to push that, and we think it's doable because it's a very top-heavy tax, and a large proportion of that's paid by utilities and large taxpayers. So you could exempt fairly large levels of assessment value without much lost revenue. So that's the idea that we're pushing this session. There's been some interest in the Senate on this, so we're hoping to get some traction. There are changes in the corporate income tax that are relatively not too revenue intensive, that the government, that the state could make to allow some of the bigger companies to and some newer companies to write off losses and have provisions closer to what some other states have. We strongly oppose increasing the individual income tax for high wage earners. We think that doesn't help, and also we have a marriage penalty that could be fixed. And then the unemployment insurance tax system, I don't think politically we're going to likely see changes in unemployment benefits, but that system is a drag on us where we rank 49th. It's not a heavy unemployment insurance tax is admittedly not a heavy business cost, but we have a particularly unfriendly system with respect to business. So all of our reports are available at ripec.org. Please and also please sign up for our newsletter or a distribution list. And I'll just finally say that we really appreciate our partnership with the league, and appreciate all of you paying attention to our stuff. Thank you.
Thank you, Mike. And let's open it up for questions. Folks, you know the drill. You can either take yourself off mute, raise your hand, or put a question in the chat if you have any. Adam, do you have a question?
Hey, Mike, hey, everybody, just a quick question. If you could just expand a bit on the phase out of the tangible tax. And if I missed something, I apologize, but would that be something that would come from the state? They'd be reimbursing us similar to the municipalities, that is, similar to the way they handled the car tax phase out? What are your
Yeah, I'm
thoughts on that?
sorry, I'm sorry, I just threw that in there without kind of explaining it. So, yeah, our proposal would have full compensation to cities and towns for the revenue loss. And Justina's done the work on this, but it would be the proposal we have is a 5-year phase out, which would basically, it would basically exempt statewide all tangible property up to $250,000 of value, which is a pretty high exemption. And we think it would only cost about $60 million. And of course, you could do all kinds of levels. I'm happy to share more information on this if people are interested, but you could do, 10,000 or 50,000. The overall tangible tax levy is over 200 million. So the idea of a full phase out is not something we're advocating for, like the motor vehicle tax. But because it's so top heavy, for example, the first $5,000 of assessed value, and by the way, that 250,000 would take out over 90% of taxpayers. If you just exempted the first $5,000 in value, and Justine, correct me if I'm wrong, it would cost about 9 or 10 million, I think, and it would take out a third of all tangible taxpayers would no longer pay tangible taxes for a very small amount of money. So, so that's why I think this is a very attractive way to go. It's just try to take out big chunks of now, cities and towns could still shift that burden over the commercial property. I mean, we would cap the tangible rate in this proposal. We couldn't have cities and towns increasing the rate to recoup the money that they're getting in lost revenue, but we think it's a good proposal. But the one other thing is that this shifting of property taxes to businesses is getting worse, at least anecdotally. We haven't gotten the tax rates, but because real estate values have gone up so sharply on the residential side, our understanding is that cities and towns have insulated their homeowners from the tax increases, and they've shifted the burden to business. Now, it doesn't mean businesses are necessarily paying more, but it means they're paying a higher proportion of taxes based on value. So so we think this disparity is getting worse, and so we do want to attack it. Justine, anything you want to add?
Yeah, I would just add that I think part of I guess the evidence that tangible tax exemptions are an attractive proposal for a lot of cities and towns is the fact that 9 in Rhode Island already have added their own exemptions, most between 5 and 10,000, but as high as 35,000. And that also we're seeing this in a number of states enacting statewide tangible tax exemptions. So, this isn't a proposal that came out of nowhere. It's kind of what we see people beginning to do to address the fact that it's a top heavy tax, and also that we see this as a potential financial saver for cities and towns, because it's our understanding that it's a very difficult tax to administer at the local level. So wiping most taxpayers off the tax roll, I think, would help with administration costs.
Yeah, and I'd add one other, that the explosion we're seeing in TSAs and things in certain cities is directly related to some of these very high commercial and tangible rates. I mean, if you're a big company coming into a new place, you're not going to voluntarily pay those high tangible rates. You're gonna have to cut a deal, because in certain communities the rates have gotten extremely high. I know they've come down a little bit with reval, but they were as high as $64 a thousand in certain communities. It's over 6% of value, so it's some very, very high rates.
All right, thanks for your question, Adam. Anyone else? All right, seeing no other questions, I once again want to thank our friends from RIPEC for this informative talk, and I will be sure to upload this information to our YouTube channel and share it with you folks at RIPEC too, if you'd like to share it on as well. And we will be communicating with you on our next workshop Wednesday topic. I will send you an invite. So thanks, and have a great week.
Thank you.
Thank you, everyone. Thanks.
Thank you.